In September, we launched our 2014 Diamond Insights report in Hong Kong, and in that we highlighted some of the very, very good structural fundamentals of the business and why we are so excited about the business today and going forward. But we also highlighted in that report a number of key areas where we feel all players in the pipeline need to invest very significantly to secure this exciting future. Those areas broadly were production, where it's clear that industry needs to continue to invest in profitable production, branding, marketing, and retail standards, where there's much to be done, and technology. Across the whole pipeline, technology will become a key enabler for all players in the pipeline. Turning to the midstream, we continue to invest very heavily in synthetic detection machinery. The group has spent upwards of $60 million in money of today terms, building detection technology in order to allow us to continue to detect and differentiate synthetics from natural diamonds, because the threat of undisclosed synthetics is still a seriously severe one for De Beers. Turning to 2015, we feel that the fundamentals of the industry remain very good in the medium to long term, and nothing has changed our view on that over the years. In fact, we're more positive about that by the day. 2015 itself, we think, will be a slightly more difficult year. The US remains our biggest market, and the economic signs in the US continue to be good. Recovery continues to grow. Consumers continue to spend. So we would expect that 2015 will be a good year in the US. 2014 in general in the US was a good year, although it was slightly slower over the Christmas season than we'd anticipated. So it would lead us to think that some caution would be required. Our remaining big markets of China, India, and Japan present us with a slightly more mixed message. China, the growth rates in China are certainly slowing somewhat, but we should remember that this comes off a tremendously increased base over the last 10 or so years. The Chinese economy has doubled in size in the last 5 years, and it would be unrealistic to expect growth to carry on at the same heady rates as before. But we would expect considerable growth in China, albeit slightly slower than perhaps last year. India is a more difficult market to read. Some structural reforms have been put in place since the Modi government came in, which we would expect to be positive from a consumer point of view. Sometimes they take some time to come through, but there is some signs after Diwali and the beginning of the wedding season that things are starting to pick up a little bit in India. In Japan, we would not expect considerable growth. Japan has been affected by a very large increase in sales tax imposed in mid-year last year and a rapidly weakening currency. So although we might see positive growth in domestic terms in Japan, we would be unlikely to see that in dollar terms. All of these economies will be affected by the rapid drop in the oil price that we've seen over the last 6 weeks or so. Net, we would say that's positive for consumers, because in the main markets that puts more dollars in consumers' pockets as they spend less on gasoline. But the impact of a weaker dollar price is quite complicated, and it will be felt differently across our consumer market. The fact that oil prices are weaker would lead to dollar strength, and that will have different outcomes in different markets. Net, we would think that drop in oil price is good for De Beers over the short term. Goldman Sachs estimates that the drop in oil price will add 10 basis points to world economic growth in 2015. When we talk about the supply-demand gap, it's important to be clear on what we mean by that. What we do is model the growth in demand over the next 5, 10, 15, 20 years against the growth in supply or production over that period. And we see that growth in demand should outstrip growth in supply. That is clearly a very, very positive for the industry and for De Beers, because it's not an industry that is going to have anything other than a supply shortage going forward. Now, clearly many things can fill that gap. One is price, but it certainly won't be price alone. There are other things that will do so too. We think things like technology will play a very important part in delivering, for example, better yield on rough diamonds as they get converted into polished. So we don't think there's any one item that will fill that gap. We think it'd be a combination of things, and that's why we feel this is such an attractive industry for all the players in the industry. Exploration is always important for De Beers. It always has been, and it always will be, and we continue to explore across the world in the most prospective places. We've had a number of licenses granted to our operations in Botswana and South Africa in the course of 2014, So there's a whole range of new areas for us to explore in the next couple of years, and we're focused on doing that. Negotiations in Angola for a new concession. Angola we regard as one of the world's most prospective countries from an exploration point of view, are now well advanced, and we continue to invest heavily in technology in exploration. We have flown a considerable area in the Northern Cape in South Africa using the SQUID, which is an aerial exploration tool done in conjunction with our technical partners at Anglo American. So we invest heavily in technology, even in exploration. Production in 2014 increased to 32.6 million carats. That's a 5% increase over the previous year, which was very pleasing. And pleasingly, that was driven by improved plant performance at both Jwaneng and Orapa, two of our very major mines. So that was very pleasing to see that technological improvements and improved discipline in the mines, in conjunction with our technical partners at Anglo American, led to increased efficiencies across the group. BOTSWANA in particular did tremendously well. Both Jwaneng and Orapa produced more than the previous year. BOTSWANA's production was 24.2 million carats, which is up on the 22.7 odd million carats done in the prior year. And that was led by, as I said before, significant plant improvements at both Jwaneng and Orapa, so very pleasing there. Namibia had another good year. The NAMIBIA Holdings Group produced 1.9 million carats in the course of the year. 1.3 million of those produced in the sea business, Debmarine Namibia. That's a record for Debmarine Namibia, so very, very pleasing. And the MV Mafuta, the principal mining vessel in Namibia, did itself more than 500,000 carats, and that too is a record, so that's very pleasing. The land business in Namibia did about 600,000 carats, also a good performance, although land was affected slightly by some production issues and a 3-week strike, so in all, a pleasing year in Namibia. In the course of 2014, we had some very good news, which is NAMIBIA Holdings managed to extend its mining licenses both on land and on sea for a 15-year period, so extending the licenses to 2035 from 2020. That's tremendously good news for the Namibian businesses, as it allows us to continue to invest heavily in the future of those businesses with much more visibility as to the right life of mine and the mining licenses. Good year in South Africa too. We did slightly less carats in 2014 than in 2013, 4.6 million carats from 4.7 in the prior year. And that's largely due to lesser grade in the Kimberley tailings facilities. In Venetia, though, we've done very, very well to optimize the pit, and we're not in the main pipe in Venetia in 2014, and that's part of the mine design, so we look forward to getting back in there towards the end of 2015. Canada, a good year, 1.8 million carats overall in Canada. That's down on the 2 million carats of the prior year. Victor had a very good year. Victor is a very sound, very steady performer and always performs alongside its budget or better, so Victor had a pleasing year. Snap had a more difficult year caused by two issues. One is water. Snap is continuing to struggle with water issues and so had to store some excess water in some of the mining areas underground, and that meant we had less headers in which to mine. And secondly, there were some very serious tundra fires in the Northwest Territories. And the smoke from that got in the mine on occasion and forced us to shut the mine for some length of time. So Snap had some production issues which we are working hard to eradicate in 2015. Cut 8, our flagship project in Jwaneng, is progressing extremely well. In the course of the Cut 8 project, we'll move 500 million tonnes of ore. Cut 8 will deliver north of 100 million carats. We'll be mining principally from Cut 8 by 2018, but a very, very big project, and it's well on track both in terms of time and budget, so doing very, very well. Venetia Underground, our other big extension of a mine project, has similarly impressive numbers. We'll move about 130 million tonnes of ore in the life of that project and deliver about 94 odd million carats. It's on track for first production by 2021. It got off to a slow start, but there's been considerable improvement in the project very recently, so that's very pleasing. Gachakwe, the new mine in the Northwest Territories that we're developing in conjunction with Mountain Province, where we are the majority shareholder, is well underway. It will be a life of mine of about 12 years. It will produce 54 million carats over its life on a 100% basis, and will move about 35 million tons of ore. Gahcho-Kué's success is very dependent on the success of the Winter Road program in Canada. The Winter Road in Canada this year is very important to us because so much equipment has to be moved up the road for the construction of the mine. The Winter Road opened early this year on the 1st of February, which is a good sign, and clearly things are very cold in that part of the world. Over 2,500 journeys will need to be made up the Winter Road while it is open in February and early March. So there's a tremendous logistical job being done there, but it's got off to a very good start.